Well, the markets might be the only ones that didn't experience a high today as the stocks fell throughout the day and closed near those lows. I'm going to take a look at this pullback and see if this is something that was anything more than expected and what we should expect out of it now coming into a new week next week. And what we have to look forward to next week that could drive stocks. So I'm going to break all that down. I'm also going to break down a sector that's really had a bad couple of days and see if there's a trade idea that we can get out of it. So let's go ahead and get started. Today is Friday, April the 20th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you who are watching for the very first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking on the red subscribe button right down below the video. You can also see it by mousing over that logo in the bottom right corner of the video player and then clicking on the red subscribe button. Click on that thumbs up icon that's down below the video too. That tells me two things. Number one, that you liked tonight's video, that you got something out of it. It also tells me, number two, that you want me to do it again tomorrow. So quick, easy way to give us feedback there. Comment on anything that stood out to you from today's video. You have to scroll down and comment down below further. And then finally, join our daily Market Outlook email list. And you'll see a link to do that in the video description below. Follow me on Twitter for more content like this throughout the day and throughout the week. See my handle at the top of the screen, at DavidSettle42. Like and retweet tonight's Market Outlook tweet there. That tells Twitter that you want them to keep pushing you more of my content. Right? It also helps me by letting other people who follow me know that this is something that they should be checking out too. Also join our Market Outlook community. We're up to 993. So if you haven't joined that community yet on Facebook, let's try to get over 1,000 people by this weekend. The address is at the top there. There's also a link in the video description down below that will take you there. If you're watching this video embedded on our YouTube player, you can click on the YouTube icon and that will take you to the page, the YouTube page to watch the video. You'll see the links in the description there. All right, so take a look at the S&P 500 with the market forecast first. And as we were talking about on Wednesday, we got that little bit of a short-term pullback coming off of, resistance on that trend line, that 62% Fibonacci area, 2,700-ish. That's kind of where we hit up against, and that gap, the top of that gap there. Pulling back down now. And if you notice here, and I talked about this a little bit in my technical analysis class today, that I've got the ovals drawn to help us from a near-term line. Every red oval, the blue oval is the current oval, and actually this needs to be changed. We need to draw. This is the current, because we're in the process of forming a new low point now, near-term low point. And you can see the near-term highs. We did get a higher high coming off of a slightly higher near-term low. And every time the near-term line gets above 50, that's when you get a red oval. Every time it drops below 50, that's when you get the green oval. So the near-term highs and lows kind of give us an idea of where we might be able to see some support and resistance, and kind of allows us to see where some support will be. You can see there's going to be some support in this 2650 to 2670-ish area based on the Fibonacci lines. And so, that's what the ovals are for. And it's meant to kind of help us see how the trend itself is developing. Right now, the bullish trend is intact. It's new, it's nascent, it's starting. You can see it's barely getting above 50. That's when it really starts, right? It doesn't start when you get above 20. It really starts when you get above 50, because when you get above 20, we can stay in the lower half of that 4-week range for a while. That's not the case right now. So we're kind of pulling back here and on SPX and looking for some potential near-term support, looking for a higher low point to develop. Of course, with the intermediate confirmation signal, that's the combination of this bullish posture and oversold momentum line. It's not the most bullish intermediate confirmation signal, because those occur when the intermediate line is already above 80. So we don't have that, but at least we have the near-term line below 50, setting up for a potential bullish low point. The near-term line had been above 50 for, let's see, 1, 2, 3, 4, 5, 6, 7, 8 days. 7 to 12 is the typical time frame, so we're right in that typical time frame. So this so far looks like a nice, good, bullish, near-term impulse move to a higher high and pull back potentially to higher low as of right now. Of course, things can change, but that's kind of what we're looking at. We were looking for a short-term pullback, and now we're going to look for a short-term bounce heading into a new week. And look for the stocks to bounce off this low, move higher, and eventually get above that that downward trending line, like it has on the Russell 2000, right? The Russell 2000, if you recall, we have broken through that downward trending line. The same thing is occurring here. You know, intermediate confirmation signal, again, not as bullish as it could be because it's the intermediate line's not above 80, but the near-term line's down below 50 is setting up for a bullish near-term low, similar to what we see on the S&P 500. You can see the same thing on the Dow Jones Industrial Average, you know, coming down from a higher high, potentially setting up for a higher low point, and you can see the same thing on the NASDAQ composite. So all the major indexes are showing that we've had that pullback that we were expecting. Remember the breakout was on such light volume, and we weren't too bought into that breakout, at least like in terms of like going up every single day, right? So we had the breakout in light volume. We weren't too confident in that on Wednesday. We were expecting a short-term pullback. We got that now, and now we're expecting a short-term bounce to continue this new bullish trend that we have going forward. And market sentiment is low. If you notice, you know, if I were to come out here to the S&P 500, the near-term line, the intermediate line on the weekly chart, mind you, is below 50 for the first time since early 2016. And before that was early 2015. We were significantly below 200-day moving averages back here. That's not the case here. We're still up above it. And then before that, before 2015, we have to go back even further. We have to go back to 2011. And you can see the 2011 intermediate line getting below 50. You know, that led to a nice, good trend, long-term trend that lasted multiple years. Now, granted, QE3 was these 2-year block right here is QE3. And it actually started in 2012. The indefinite portion of it started in late 2012. Right, it was announced earlier here, and of course you had Operation Twist over here that got us off that credit downgrade, and that low point was also below the 200-day moving averages. So, you know, again, before that, the intermediate line hadn't been below since 50 since the QE, since QE2 was announced. So you can see we don't get very many opportunities with the intermediate line on the weekly chart below 50. And so the positive sign that you'll need to show that we are now turning up higher and this intermediate line can turn up for a while is getting the near-term line up on the weekly chart, getting the near-term line up above 80. When the near-term line gets above 80, then you say, okay, we can turn up for a while. Now keep in mind, market sentiment is already very high. So that's something that could be working against. But again, back here in this run that we had coming off of the 2011, you can see market sentiment had dipped a little bit, but by the time that we had started to rally off that low point right here, market sentiment was also pretty high. Not as high as 75, but it was pretty high. And then we had a multiple year run where market sentiment was above 80 for a long time. So needless to say, we can get that again. We don't necessarily need market sentiment line to be that low, but you can also see why this move was so big, because market sentiment was, you know, down below 60, the lowest on the weekly chart it had been even since the recession. Even these lows didn't get market sentiment line that low. And you can see also too that market sentiment drops down here after the intermediate line drops down. The intermediate line drops down below 50 on the weekly chart. Market sentiment line dips afterwards. Here you had a couple of them in a row. That's what brought it down so low. And now, so, you know, again, we're going to get another low point. Is it going to be like this one in 2010, where it's only multiple months before we get another dip? You know, or is it going to be like 2011, where you know, we end up with a multiple year run? Probably more like 2010. I don't think we're going to get a multiple year equity run out of this. A year plus will probably be our best bet, considering how bullish we've been for so long. All right, if you're watching the video embedded in our Market Scholars blog, there's 3 clicks I want you to do while you're watching. You can do this right now while we speak. Number 1, I want you to click on this heart. That will like tonight's Market Outlook tweet. Number 2, I want you to click on the thumbs up for you, those of you that have Facebook accounts. That will like it on my Facebook page. And then number 3, click on that green button there. That will like it here on this blog. So those 3 clicks tells me you want me to keep doing this. I also, if you haven't already joined our daily Market Outlook email list, you can do it right here as well. And then finally, down here at the bottom in the comments section, reply to this post with one thing that you got out of the video tonight. So that way, everybody else who's watching can come down and see why it's worth it to them to want to watch this video. So look at this. You can see with this short-term pullback we had at the end of the week, it got us back to the point where we didn't get a green arrow on that 50-day moving average. We fell back below just a little bit, but we fell back below that 50-day moving average. Again, not too sold on that breakout, and we saw that. But again, I don't see this as anything more than this a short-term pullback until we break back down into this area and we get to a lower near-term low point. You know, right now we're coming down from a low near-term high. We expect a higher, we're coming down from a higher near-term high. We expect a higher near-term low to develop, ideally in that Fibonacci area that you'll see here in just a second. When you look at the 3 green arrows, you can see, yeah, we got 1 red arrow, and the MACD and stochastics are both pulling back to their moving averages. The MACD, the stochastics is up above here. You know, it's in the 87th percentile. So it's in the area where the bulls are in control. So they, you know, it can pull back, you know, where it wants to and just be fine up there. Even if it gets below its moving average, you can see it can fluctuate when it's in these high areas here. The MACD can also go up and down around as long as it's above its moving average. So we'll see if it crosses below that. That's when you'll see the histogram drop below 0. You also see it's still above 0 itself, which means the 8-day moving average is still above the 17-day. We did drop back down below the 8-day moving average. We held the 17 before closing level, so those are some levels we want to keep an eye on as we're converging. See, we've diverged and you know we diverged to the upside, came down, diverged back to the downside, and we've had some ups and downs here. And the expectation now is that we will diverge to the upside if we're going to trend higher, or if we don't, if we break down below 2600, 2575, that's your bearish sign that things are really hitting the fan with this, what would be a descending triangle here, which usually doesn't work as a reversal pattern, descending triangles. So that's why I'm not expecting that per se, especially considering, like I said, the Russell 2000 is already broken above its moving average. There was also something else I tweeted out here from Ryan Dietrich. I like this tweet here about the fact that the new highs are breaking up to the advanced decline line, new highs line, are breaking up to new highs themselves. So that is typically a leading indicator, and another reason why, you know, I would expect this breakout, a divergence on these lines to the upside, not another one to the downside, and remaining to be bullish here, despite the short-term pullback that we're getting right now to what, you know, could easily just be a higher near-term low point. The high of the day was early on in the day. The low of the day was late, so we had, you know, a little bit of a bearish trend, obviously, breaking down below last week's high point, closing below yesterday's low point. So a bearish candle. We did get a little bit of a pullback here, a little bit of volume too, more volume than what we've seen on the up days over the last couple days, getting up to where it's almost average volume. But I wanted to show you, so now we've pulled down the 4-week high point to the high of this week. So again, we are in the upper half. So after toiling in the lower half of the 4-week range for so long, we have now broken through, and we never did really break through. We pulled that upper line down, and we're off the low so much that we're now in the upper half of the 4-week range, just like that. Right, and you notice the midway points right here about 263, and these Fibonacci retracement lines is of the latest near-term run that we've had. So you can see off that low point, this latest near-term run, You know, we're right about at that 38% Fibonacci retracement. There's some old highs over here, you know, at this 266 level. You've also got some Fibonacci. This Fibonacci retracement zone goes all the way down to that 4-week midpoint. So like I said, we can trade anywhere in here and still be fine from a bullish perspective, and it would be a higher low relative to the last near-term low. And ideally, like right here would be the area. This would be the ideal area for that near-term low to develop. And then we bounce off of this and continue higher to a higher near-term high and continue this bullish intermediate trend that we're on with another 7 to 12 day near-term run like this one that we had just right here. Now, of course, that's expectations. I think, you know, everything doesn't always happen according to expectations. That's why we manage risk. And we use stop orders and position size. Otherwise, we just go all aboard, right, according to our expectations. Things don't always happen that way, but it doesn't mean that we can't use these charts and see how they've worked in the past and how they behave to determine what we expect to see going forward. And that's kind of what we have right here. We expect that we'll get a short-term bounce off of this and move up to what would be a higher near-term high. And if we don't, then we'll plan accordingly. Volatility has been rising. You got notice it got up to 17.5. If we do bounce off of this, I don't think, you know, we'll get the nice orderly near-term rallies that we were getting like in 2017. Things will be a little bit more volatile. We have a higher volatility. Remember, you know, current volatility levels is higher than we ever had in 2017. So that means that we'll have more ups and downs. Things will seem crazier than what we've been. And if you got used to how the market moved in 2017, know that that's the anomaly, not this. Right? This is the anomaly, to have such a move for so long with such low volatility. And also to know that, you know, we'll get some ups and downs, and the downs will be relatively big, like we've seen in the last couple of days, simply because that's where volatility levels are right now. On a relative basis, we are still in that neutral area between 90 and 95%. We're actually sitting right at that 95% level. And again, another reason why we weren't so bullish before is because we hadn't broken through 90. If we break through 90, expect the VIX on the absolute basis to start coming down to closer to that 12.5 area, where we might find some lows and start to bounce off of that ups and downs. I don't think we'll get back down to the single digits again. We're not in that mode anymore. But 12.5, I can see that on the regular VIX here being the low point that we start to bounce around here and go up and down off of that, kind of ratcheting up this range to another level. So if this was the first floor, now we'll start using the second floor, right? The ceiling of the first floor will now be the support for the second floor of volatility as we head into, you know, the rest of 2018. All right, now let's transition to what's driving the price action. You can see on the calendar there was nothing today necessarily to move the market. There's a little bit of a pullback. Again, remember the bullish move was so light volume that we're just getting the pullback here. Economic indicators are still very strong, especially relative to where you see everywhere else. In Europe especially is really bad. And so you can see that reflected in their GDP. And the big news, you know, that's coming out next week is GDP will come out. The advanced number for the first quarter, the last revision here is now at 2%. So we'll see if that ends up being. Again, that number would be a strong number for the first quarter relative to past years, and I've talked about that before. You can see now the odds are rising, continuing to rise here for a rate hike in June. You can see there's the odds for the one rate hike in June. The odds for the second one are rising. You can see the odds of staying at just the one are falling for September. And then in December, of course, everyone's watching that one. That's the wild card. And people are looking for that fourth rate hike or not. And you can see the odds of only one or two are falling, and the odds of three or more, most likely three, are rising. And so, or the third one, excuse me, for the rest of this year. So that would be 4 total for 2018, since we already have had one. And so the odds of these, you know, rate hikes are rising up here. And if you take a look, you know, that's why those yields, look at the, did you see the 10-year note today? That 10-year note breaking up above these old highs, getting up to 2.95%. Now, 3% is the big one. There's a lot of chatter about how we broke up through these highs. Well, yeah, I mean, that's you got up to these highs, but that's such a divergence level possibility there. It's not till we get above 3%. That's the big one, right? That's going to be the big level. That's a big round number. We've hit that before in the relatively recent past. And so you can see if I were to do like a look at the MACD and stochastics on this, right? You can see like getting up above here just barely is not going to even come close to new highs compared to what the MACD was there. So, you know, possibilities for divergence exist if we can't get above 3% on that, on the MACD, and anything else you want to take a look at, whether it's a weekly chart or not. Go back to the long-term moving average. So I'm not too necessarily sold on that breakout. I mean, that's great, but we're so far up above the 200-day moving average. It's not like we're coming off of it and going to start a new run here. See, here when we started that run, we were still relatively close to the, and the gap between the 50 and 200-day moving average was still really small. So here we're already pretty large. So we're going to need a big move, and there's that 3% mark from late 2013. Right there. We haven't come close to matching that since then. Remember, the Fed had kept a rate. The Fed, all these levels here, the interest rates were at 0%. The overnight interest rate was at 0%. So it's not like, you know, we've been raising rates. We raised rates once in the end of 2015. We raised rates again at the end of 2016. We raised rates some more in 2017, coming off the election. So we've been raising rates. I mean, we're up to, you know, what, 150, 175 right now. We were at 0 to 25 during when the long-term rate was right here at 3%, right? So we're back to 3% now with interest rates higher, 150 basis points higher than they were here. So this isn't like, you know, getting to this level isn't necessarily something that's like, whoa, this is so crazy, right? Because, you know, we should be beyond that level, considering how many times, you know, we've raised interest rates off of that 0 level where we were in this area. And if you look at inflation expectations back here when we were at that 3% level, again, when the overnight rate was at 0 to 0.25%, right? We were at this, the end of December of 2013. We come back over here, to the inflation rates at the end of 2013. So we're looking right in this area right here. We were up at 2.8%. So inflation expectations were higher. The overnight interest rate was lower. And we're not, you know, we're getting up to 3% now. So, you know, we should be pushing through that 3% as this starts to move higher with where the overnight rate is now compared to where it was back here, but we're not. And so that's why I'm not too sold until we break 3%. Today's breakout was great, but I'm not too sold on that. And you can even see today, when you look at the inflation expectation, it dropped down. Now, again, I'm not too, I mean, it's look at how it goes up and down, up and down, up and down. So it's, you know, we'd have to smooth that out a little bit to really get an idea. But the trend, if you were to smooth that out, is to the upside right now for inflation expectations. So yields are expected to go up, and that's obviously had a negative impact on bonds. You know, bonds had the worst performance of the last couple of weeks, and especially the worst performance this week, down 2% this week. Commodity, you know, energy prices were up 1.5%, pulling back here late, but they were up 3% at one point, kind of reflecting and off of a 2% low point early in the week. So that's a pretty big move in commodity prices, another reflection of rising inflation expectations, pulling back here just a little bit today. You can see how U.S. stocks pulled back to those developed countries and emerging markets suffering during the drop in crude oil prices as well. All these falling, you know, gold even having a down day with the dollar bouncing up today. Today, the dollar had, you know, the biggest move out of anybody. Very, very strong move for the dollar. I wouldn't, you know, buy a whole lot into that yet. The dollar's been on the bearish trend If you were to take a look at this bounce back up, we're basically bouncing back up to the top of this range it's in. We'd have to break through that if we're going to be really bullish on the greenback. Otherwise, again, the expectation is to break out of this triangle in the same direction that we came into the triangle. You can see on the weekly chart how that even looks more. And there's if I were to look at the 50 and 200-day moving averages, there's the 20-week moving average stuck in the middle as we continue to trade below that on this bearish trend. So we have to get above that before we're going to be anywhere close to being bullish. But if you now look at the 1040, the 50-day moving average, that's what we're trading around. We're still kind of consolidating in that area. Again, the expectation is to break out of this with the same move you had coming into it. Doesn't mean we have to do that. I'm just saying, and I threw this line on here as the possibility of a head and shoulders. If we would have had that kind of move here, then we, with another move up to the new, to the neckline, to what would be a neckline, if you were to peak at that level again, then you would have the possibility of a inverted head and shoulders development. But we didn't get that kind of consolidation. We got a sideways consolidation right into that moving average. So another sign that today's move might be very temporary, and we'd expect to break down to the downside coming out of it. Doesn't mean it has to happen, of course, because anything can happen, but that's what we'd expect. Interestingly enough, Staples really had a bad week, and most of their weakness came, and there was some weakness with bonds rising, or bonds falling, early in the week. They suffered there a little bit, and with the yield curve flattening, financial stocks are kind of getting hurt from that regard. But you'll notice that this last couple of days, those staple companies really tanked like a rock, down 4% for the week. Really, really down, where the market was actually up 0.5%, and nothing else was even close. So that was the big outlier there. Of course, energy stocks doing well, with energy, with crude oil doing well, and commodity prices doing well. Materials also outpacing. Some of these other areas also benefiting from earnings. You can see utilities doing well despite the rise in yields. Not real estate, though. Real estate suffering down here, and technology suffering, again, because of earnings, IBM being the latest one. So you're going to have some ups and downs in some of these sectors simply from who's announcing earnings and how that can impact that on any given day. So here's just today, and there's your earnings related, technology sector, Staples struggling, financials bouncing, but remember, they're bouncing because they've been so weak. So I wouldn't read a lot into that bounce. So there's 4.5% drop in 2 days on consumer staples, 0.5% gain on financials when the market itself is down 1.5%. So just a bounce back, in my opinion. Big drop in the yield curve and the yield spread. Big drop in the yield spread. That's been weighing on financials. We've had a little bit of a bounce in that yield spread today, or this at the end of the week here. If I were to look at the ratio chart here for the yield spread, give it a second here to load. There we go. So you can see the long lower shadow on the weekly chart the last couple of days. So there's your bounce back up, and there's your bounce back up in financials because of that. So temporary, in my opinion. The trend is still downward in the yield spread. I don't think we're going to invert anytime soon. There's going to be some ups and downs, but the trend is negative, and of course we know how that impacts. But that's the biggest one to the downside. I mean, that's the XLP is really kind of having a really bearish move. There's this is on the daily chart. Let's look at the weekly chart here, and you can see breaking below 52.50, breaking below the lows the last couple of weeks. And I mean, again, look at that compared to SPY on the left scale chart here, and you can see how SPY came down and tested that February low point. XLP went below it. SPY came down to some, that 2675 level here in the last couple of days. A little bit of a short-term pullback to most likely will be a higher near-term low point Staples dropped to lows that was far below those February low points. So very, very bearish move for Staples. Let me get rid of the left scale chart now. You can see down the 50-day moving average falling, the 200-day moving average falling. Things are looking very negative. When they look very, very negative like this, eventually there's going to be some opportunity to buy really cheaply as the market rotates into. But right now the market's rotating out and rotating into those materials and energy stocks. So, we talked about XLE. See how it's done over the last couple of weeks here. And again, on the 5-year weekly chart, breaking up above and moving a little bit higher. And of course, the other commodity-based index, XLB, getting it back up above its 50-day moving average, whereas the broad market couldn't. So a little bit of a pullback in the last couple of days, but you can still see closing above the high of the last week, despite that pullback. So one of the stocks in that consumer staples area that also broke down, especially today, ahead of earnings coming up here in another couple of weeks, is Molson Coors Brewing Company, TAP, T-A-P. You can see really breaking down below that lower Bollinger Band. You can see down here at the bottom the Bollinger %B getting below 0, which means we're below the band. We've been below the band before a few other times here. We've been on a bearish trend right now as we continue to trade below this 50 area. Brief bullish trend here, but that didn't last very long. So we're on a bearish trend. We're breaking down to a lower lows with some strong volume today. So breakout, the bandwidth suggests we're really, really close to the squeeze area, a lot closer to the squeeze area than we are the top of the bandwidth. So it's there's potential for a trend to come out of this, especially with the high volume. So of course you got some strong resistance at that 72.50 level. If you were to look at these weekly options and sell, it's going to be relatively expensive. It's got a 15% wide spread on a $1.50 ask price. That means you got a 10%. That's about the maximum we're allowed to be, is in order to get good fills and good price and be able to get out okay. So if I were to sell that 72.50 call and buy 74.50, I'll probably get around this 50 some odd area. 47 cents is the magic number. That's the 30% return on risk. So anywhere in this area, if I can get filled in, then I'd get enough of a return to justify the risk according to that 30% figure, that target rule of thumb. You can see if I were to set that break even with 67% odds, there we are. So as long as we stay below that moving average and stay on this bearish trend, we're fine. And if we ever break back up above that, then we know we can take a loss of about 40, 50, 48 bucks to 50 bucks, and that's about the kind of gain that we were trying to get in the first place as well. One thing to look at seasonality, from a seasonality standpoint, on TAP, T-A-P, come here to seasonality, change this to a price percentage. You can see that normally we are typically riding a pretty good bullish move from a seasonality standpoint. That has not been the case. We've been on this bearish trend. We're down 14% year to date. But then this is the time of year where it just goes flat as a pancake. Ironically, in the summertime, you'd expect more consumption to occur. It's at the end of the summer where the stock really takes off normally, from what is a 0% gain for the year over the past 20 years to a 7% gain for the year. So, usually we start off pretty weak at the very beginning of the year coming out of the Super Bowl. That happened again this year, but we typically bounce, and we were bouncing just fine, but this happened. And so we're on a bearish trend. We're heading into a flat time of year, and this would be okay. Remember, 72.50 is right there where my blue line is. So as long as it stays up here and vacillates like that, even through earnings, then we'll end up, June 1st, right in this area. As long as it stays below that line by the beginning of June, then we'll be fine. We'll get the credit that we need to justify the risk of the trade, even with that earnings coming up. And because of that earnings, what we do the earnings, and with that earnings announcement coming up, there is a heightened risk And to accommodate for that, what we'll do is we'll position size smaller than normal, position size around max loss. We don't want to take max loss, but we'll position size around it just in case things were to go crazy. And then we will position size so that if we do take max loss that is smaller, that loss will be smaller than what we normally would take on a good setup that doesn't have that big question mark of risk, that earnings announcement that's looming in the midst before we get into that June expiration. You can see, the stock is pretty volatile right now, and it's expected to be just as volatile going forward. So, in the past, the earnings has been pretty darn volatile, but here in the last couple, there's been some big moves within the range. So we had a big move there, but we had a big move coming into it. Here, we didn't have that big of a move coming into it. We had about the same kind of move coming out of it. This is the one that's been kind of that wasn't even in earnings. This one was the outlier where we had we were really consolidating and we didn't have any kind of move heading into it, and we broke out to the outside. Same one here, and both of those we made the big move and quickly reversed it because there wasn't any, we didn't have that same kind of move coming into it. All right, so that wraps us up for today. As always, thank you very much for watching. I appreciate the time that you watch these videos night in and night out. I know your time is valuable. I want to make sure that these are worth your time that you spend. So thank you again. I appreciate it. Remember to subscribe, like, and comment on the video down below. Also, remember to follow me on Twitter for more content. Make sure you, if you're watching this on our blog, look at other stuff that's on our blog as well. And then finally, also remember to join our Market Outlook community. Let's get over 1,000 here. See if we can get over 1,000 this weekend. That being said, thanks again. Have a great weekend, everybody, and we'll see you all on Monday.